If you would like to purchase your first home, but you still have student loan debt, then stick around because I'm about to give you the keys to achieving your dream of home ownership, even with student loans still in the picture. Hello and welcome to Practical Personal Finance, where you get the information you need to understand and succeed with money. If you're dreaming of owning a home but you're still working on getting those pesky student loans paid off, have no fear. It is possible. In the next few minutes, I'm going to educate you on how you can put yourself in the best position to qualify for a mortgage, help you understand how much you need to save up, and tell you the 3 secrets that will make you more likely to be successful as a buyer. Assuming you're going to be using a mortgage in order to buy this home, it's important to make yourself as attractive of a borrower as you possibly can. You're already at somewhat of a disadvantage because of your student loan debt, so it will be extra important to focus on your credit score and your debt-to-income ratio. Your credit score is what's going to be used to determine whether or not a bank is willing to lend you money, and if so, at what interest rate. A good credit score can help you qualify for a low interest rate and an inexpensive rate on PMI, even with a small down payment. This will all result in a lower monthly payment, which is going to be absolutely critical. So before you apply for a mortgage, make sure your credit score is as high as possible, ideally 700 or higher. If you need a quick refresher on how credit scores work, or some strategies to boost your credit score, I made videos on both of those topics and I'll leave links down below. That leads us to this thing called debt-to-income ratio. Once a lender has deemed you worthy as a borrower based on your credit score, your debt-to-income ratio is what they're going to use to determine how much they're comfortable letting you borrow. So what is your debt-to-income ratio? It's a measure of all your monthly debt payments that are being reported to the credit bureaus against your monthly income before taxes and other deductions. Here's an example. Let's say your monthly debt payments include $750 for student loans, $450 for a car loan, and $100 for a credit card. Note that these amounts are the minimum required monthly payments. You can always pay more, and you most likely do, at least with your credit card. When calculating your debt-to-income ratio, though, the only thing that matters is the minimum payment. Alright, so with those 3 debts, your total monthly debt obligation is $1,300. Now let's look at the other part of the equation, your income. This one's pretty simple. Let's say your income is $60,000 per year. That's $5,000 per month before taxes. So we take $1,300 and divide that by $5,000 and we get 0.26 or 26% for your debt-to-income ratio. If that all makes sense and you're getting some value so far, let me know by giving this video a thumbs up. Thanks. So this percentage that we just calculated goes a long way toward determining whether or not you can qualify for the mortgage you need to purchase the home you want, because your lender will only let you borrow the amount that will increase your debt-to-income ratio to about 50% at the very most. Here's an example to illustrate how that works. Using our numbers from earlier, 50% of $5,000 would be $2,500. That's the most your lender believes you can afford to spend repaying all of your debts each month. They know you still need to buy food, pay the electric bill, and put gas in the car. Not to mention the chunk of your income that goes directly to Uncle Sam. They don't want you to be stretched too thin and not be able to pay them back. So if your maximum total debt obligation is $2,500 per month, or 50% of your income, and you're already obligated to pay $1,300 each month for your other debts, that leaves a maximum of $1,200 per month for your mortgage payment, including the principal, interest, property taxes, homeowners insurance, private mortgage insurance, and HOA fees. Will $1,200 per month get you the home you want? If not, you need to lower your debt-to-income ratio, and there are 2 ways to do it: increasing your annual income or reducing your monthly debt obligation. If you got a raise and were suddenly earning $70,000 per year instead of $60,000 per year, your debt-to-income ratio just went from 26% down to about 22%. If you then paid off or sold the car you were paying $450 per month for, your debt to income ratio would drop from about 22% down to about 14.6%. Suddenly, your maximum mortgage payment is a little over $2,000 per month, and you have a lot more options for homes you can afford. Next, let's talk about the money you need to save up in order to make the transaction happen. You're going to need cash on hand to pay for a down payment and to pay for something called closing costs. For your down payment, the ideal amount is 20% of the purchase price. But you and I both know that's a fantasy for someone with student loan debt. So don't worry if you don't have 20%. You don't need it, especially if you have a good credit score like I talked about earlier. With a good credit score, you only need 3% of the purchase price as a down payment. But I would suggest aiming for a minimum of 5%. It'll be a few $1,000s more, but you'll have more flexibility when you're shopping for a home, and you may even wind up with a lower interest rate. Then you need to budget for closing costs. This includes things like mortgage origination fees to compensate your lender, home inspections to ensure there aren't any major surprises after you move in, and a real estate attorney to review all of your documents and make sure the seller is the sole owner of the property. I would suggest saving $10,000 to cover your closing costs. If you don't end up spending it all, you'll have some spare cash to cover moving costs and new furniture after you've moved into your new place. As an example, if you were looking at homes for $300,000, I would suggest saving up $15,000 for a 5% down payment and $10,000 for closing costs, for a total of $25,000. Now, I know that $25,000 is no small sum. In order to get there, you'll almost certainly need to focus on boosting your income and cutting your expenses, at least in the short term. In my case, eliminating my $300 per month car payment was huge. It allowed me to save an additional $3,600 over the following 12 months. Both my wife and I also worked as many extra hours as we possibly could, even after becoming debt-free, which put us in an excellent position to go house shopping. Consider what options you have for generating some extra cash, and think about how you can cut your largest monthly expenses. Make the minimum monthly payments on your student loans and direct all of your extra money toward your house fund. It's not going to be easy, and it won't happen overnight, but it will be worth the trouble. Last but not least, let's have an honest talk about how flexibility will impact your ability to purchase a home. Coming from a situation where you're renting and still having student loan debt puts you at a distinct disadvantage compared to other buyers who may be debt-free or who are purchasing their second home. That's because those other buyers will have more flexibility compared to you. And when you're shopping for a home in a competitive market, which seems to be the norm these days, flexibility is important. Someone who owns their own home will have more flexibility with when and how quickly they need to move. Someone who is debt-free will undoubtedly have an easier time saving up a larger down payment, and they'll have a lower debt-to-income ratio. These factors make it more difficult for you to compete with other buyers. Let's look at why that is and what you can do to close the gap. First, flexibility on timing. Homeowners don't have leases with very specific end dates. Renters typically do. So if you're renting, you're faced with the task of buying a home right at about the same time your lease is ending. Not an easy task, especially if your lease is up in the middle of winter when there are fewer homes available on the market. If you have a year or more of saving ahead of you, make a plan to mitigate this issue. When you renew your lease, see about having the end date be between May and October. If it's currently at the end of February, maybe that means asking for a 16-month lease at renewal rather than a 12-month lease. Or better yet, ask for a month-to-month agreement at the conclusion of your next lease, so you can move out whenever the time is right. If you have a private individual owner as your landlord, you might be surprised at their willingness to accommodate you and help you out, given your intention to become a homeowner yourself. When I purchased my home, my landlord allowed us to go month to month at the end of our lease, and she prorated our rent once we completed our home purchase and had a definitive move-out date. As a result, we were able to move out whenever we were ready, and we didn't have to pay rent for a single day we weren't living in the rental property. I couldn't have asked for a better situation. Second, flexibility with cash on hand. Someone who is debt-free can save a lot more money a lot faster than someone who has student loan debt. More cash on hand gives you more options when purchasing a home in a competitive market. If you have a 30% down payment saved, you can afford to reduce your down payment to, say, 20% and have thousands of dollars left over to negotiate with. With extra cash, you might feel comfortable giving up the right to negotiate with the seller based on the results of a home inspection, because you can afford to fix a failing HVAC system or a leaky roof. More cash on hand also gives you the option of offering an amount higher than the asking price and giving up the right to negotiate with the seller based on the results of a home appraisal. The amount your lender is willing to let you borrow will be based on the home appraisal value. You can't go and borrow $500,000 to buy a home that's worth only $200,000, because then your lender will be in serious trouble if you can't repay the loan. In a situation where the offer is for more than the appraisal value, the seller can either agree to reduce the price to that value, or the buyer can use extra cash to pay the difference. Guess which option sellers prefer? Extra cash is king in a highly competitive market. So the moral of the story is that you need to look in areas that are less desirable and for properties that are less competitive. I found my house by looking at properties that had been on the market for 2 weeks or longer. The seller had done a poor job marketing the home to potential buyers. My wife and I were able to negotiate on the asking price and then request certain repairs be made after our home inspection. Couldn't have drawn it up any better. Third, flexibility with budget. Someone with a low debt-to-income ratio will have a lot more purchasing power than someone who has student loans and a higher debt-to-income ratio. They'll be more easily able to afford homes with HOA fees, higher homeowners insurance rates, and higher property taxes. Let's say you've got $1,200 per month to spend, like in our earlier example, and you're looking at a home with a $150 per month HOA fee. It's in an area that's been known to flood in the past, so the homeowner's insurance is going to cost you $200 per month. And it's in a state with high property taxes like New Jersey. That'll be $600 per month for those. In that case, you'd be up to $950 per month in taxes and fees and have just $250 per month left over for mortgage principal, interest, and private mortgage insurance. That home purchase is impossible. It will never happen. Instead, what you need to do, especially as someone with student loan debt, is look for homes with no HOA fees in areas where there aren't any natural disasters to worry about with low property tax rates. It's not easy to find a house that combines all three of those factors, but if you do, you'll be able to maximize your purchasing power, so it's worth trying. It's important to remember that buying a home with or even without student loan debt is a long and potentially difficult process. You need to have patience and confidence that the right deal is going to come along. It might not happen as quickly and easily as you want it to, but I can promise you that the end result is 110% worth the effort. On that note, if you ever need a pep talk, want to share a tough story, or have any sort of conversation about money, come check out the PPF Discord channel. Link is down below. Are you looking to purchase your first home despite your student loan debt? I would love to hear your story and answer any other questions you may have. Leave a comment down below and I'll do my very best to reply in a timely manner. For an explanation of whether or not now is a good time to buy a home, click right here. For a deep dive into the actual process you'll go through to complete your home purchase, click right here. And if you're not yet a PPF subscriber, click right here. As always, thanks for watching. I'm Andrew Shear, and I'll see you next time.